So, this is something that we all need to address in our organization. So we'll go ahead and get started. And I always like to get started with a few ground rules. There we go. And today, what I will try to do when I do my presentation, I will attempt to be impartial, and I'll attempt not just to read the slides to you and make this a giant reading session, but have a more of a discussion and use the bullet points more of a guide. But I want to just be clear that credit policy, there's not a lot of classes out there to go to, like let's say if we were talking about cash flow or activity ratios or turnover or letters of credit. So it's a lot tougher to present material based on research. So I'm going to tell you right now, I'm trying to be impartial, but some of the things I will tell you will be influenced by my own experiences. But the other ground rules of today that we're going to try to get through is that the credit policy is our best friend. And then the other ground rule, and this will be important because sometimes you might disagree with me, but you have to understand where I'm coming from. It's not the role of the credit manager to create zero risk. Risk is a part of credit, and what we're trying to do is manage it. Also, part of the rules and where I'm coming from in this presentation is that there is risk in not making a sale. So we have to understand that as well. And that another ground rule is bad debt and past due is just unavoidable when granting credit. Finally, second to last is that a manager must understand profitability to manage risk. And the final ground rule of today, where we're coming from, is the old rule that bankruptcies occur suddenly but not unexpectedly. So why do we avoid credit policy? Well, I think the number one reason is it's not fun. Unlike, and when we discuss credit policy, I think everybody else besides credit thinks we're having so much fun, sort of like my picture here of Sheldon Cooper with Fun with Flags. But a lot of people obviously don't see the fun in credit policy as maybe the credit manager might be. Additionally, policy is always wonky, and that's not always a fun part of our job. Sometimes we enjoy meeting the customers, traveling, the other exciting aspects of being a credit manager, but sitting in a room writing a policy is not the most exciting endeavor. Also, in my surveys, in my experience, I find that a lot of times companies do not have an organizational mandate to create a credit policy. And so if you're here today attending on how to get a credit policy started, that might need to be your first step. And finally, I'll say here that busy credit managers often put updating policy on the back burner. And I will tell you, for me, that's guilty as charged. So the title of this was Dust Off the Credit Policy because the auditors are here. And this is my surveys when I talk about policy in some of my presentations. When I ask the room to raise their hands, I find that about 40 to 60% of the participants raise their hand that they have policies. Many of those participants, you get that half hand raise up in the air, and I interpret that meaning their policy is not up to date, or it's not up to where they want it to be. Then finally, and we'll talk about this in the second half of this presentation, is that a lot of times credit policies don't address more important topics, which is internal credit ratings, bad debt reserves, asset classifications, write-offs, delegation authority, and bad debt accountability. And finally, I think why we avoid writing policies is there's just not a lot of reference material on credit policies. So in my research for today, I found that a nice paper published by the Credit Research Foundation called How to Write a Credit Policy by Cliff Miller. And that will be, I'll give a link when I send this presentation out. I don't know if the CRF makes this publicly available, but if you're a member, you certainly can get that paper. And I also found a book on international credit and collections by Mary Schaefer. And in chapter 1, she talks about writing an international credit policy. It might be a good book for anybody out there that is interested as your company expands into international credit to get this book, although it is becoming a little dated. So This is another problem I think we have, is that we have a different perspective of what credit is and what credit policy is within the organization. Here's the salesperson's perspective, and again, my promise not to read the slides is basically everyone wants us to release orders, collect past due, don't mess with their customers, but the moment the customer goes bankrupt or is about to file bankruptcy, credit magically inform everybody, we suspend the sales, collect the past due, and we get out of the credit relationship with no losses. And honestly, this is a lot of what the sales perspective is on what a credit should do and the credit policy. But unfortunately, we know that isn't, but do we? I think often I find that credit managers want to be the credit hero of the organization, fighting the forces of bad debt. And sometimes they fall into the sales trap where they can eliminate all bad debt, and there will be no past due, and they'll, boy, by God, I'm going to collect that money no matter what the risk is. And that's not really what a credit manager's role is. So here's the reality of the credit sales, is that if you're going to sell on credit, you're going to have bad debt and you're going to have collections. However, there is a risk in not selling to his customer by lost sales and profit. And here's the questions or the considerations for a credit policy or credit in general. Do we truly understand the risk of the customer using the information we have? Can we mitigate the risk with credit enhancement tools? And then this is going to be a theme of this presentation. Does the profitability of the relationship warrant incremental risk? When I say incremental risk, figure out what your normal tolerance is in your company and clicks above that tolerance. Does your policy address specific bad debt reserves so you can fund the bad debt reserve? And what I mean about this, so often we look to credit insurance to possibly mitigate our risk, but we can create our own self-policy within a company by sufficiently funding our bad debt reserves. Here's a biggie. Does your credit policy allow for riskier sales with the appropriate delegation of authority? Or as I write here, are you always putting your name on the line? And how are others in your companies held accountable for making poor credit decisions? And what I mean about that is sometimes we do let a division or a sales manager take incremental risk, but do we hold them accountable for that decision? Do we make them take the bad debt hit? Do we make them fund the reserves? So here, from my perspective, again, this is my background and experience, this is what a good mission statement of credit policy should be, which is we're here to minimize the bad debt losses, efficiently collect the past due, while at the same time work with sales functions as they grow profitable sales revenue and market share. And again, the objective should be to minimize bad debt, not eliminate it, work with sales, not against it, and managing the risk, which is always present in credit sales. Now I'm going to stop here just for a moment to let you know that this is clearly influenced by my background. Some of you that may be in trading companies, you would never, many trading companies don't involve sales in customer visits and credit decisions because you're writing both sides of the contract and that you don't want your traders or your salespeople involved in the credit process. I get that, but I think the major theme of what I'm trying to get through does apply, that there should be, at least some cohesion between everybody in an organization. So in the CRF paper, which is a really good paper on writing a credit policy, Cliff Miller, I think what he's trying to accomplish in this paper is not tell you how to do it per se, but he gives you the questions to ask. And but before we get into that, he lays out 4 reasons to have a credit policy. And number 1, it's a serious undertaking. It's the largest asset in many companies. I know in our company, the receivable is very close to the inventory level. I've worked in other companies where the receivable is the largest asset by far. And you have a great responsibility as a credit manager taking care of that asset. Another second reason he hypothesizes is the consistency among departments, I think is a biggie, and we'll realize common goals. And the last point he makes is duplication of effort. And I think a good example of that, sometimes I see in credit application processes where credit departments ask for the exact same information as their customer service department in establishing new accounts. Third, credit policy provides a consistent approach among customers. And maybe your customers wouldn't know it, but your internal customers know that. For sure, we want to treat all of our customers equally. Finally, the last important point he brings up is that he wants to raise the level of the credit department as a separate entity, which is worthy of providing input to the overall strategy of the firm. In other words, we want to be a valuable asset to upper management. We just don't want to be the person who's releasing orders and collecting payments. And we'll get into that later about how that can happen. So finally, let's go back here. One of the reasons we said we did not have credit policy is we don't have a mandate from our company to have a credit policy. So if you're in that situation, we're starting on page 1. You guys are on page -1 right now. And here's the idea of the mandate for the credit policy. And I apologize, I'm going to read this because this follows some logic. The board of directors, depending on the organizational structure of your company, the management group or the ownership group, is responsible for credit and the asset quality. Number 2, thus they have to charge management to create and maintain a credit policy to ensure asset quality. Then number 3, ownership creates a delegation of authority for management to make credit decisions. My hint is that the credit authority should flow down to the CFO, not to the CEO. Number 4, the CFO will delegate some of that credit authority to the credit manager and charges that credit manager with creating and maintaining a credit policy. Number 5, if 1 through 4 are true, then organizational conflict can be avoided. Now you may say, why is that? Well, my hypothesis would be here that if you are making credit decisions, not only credit limits, but order releases, anything to do with credit, you're speaking from management and from the board, which creates a mechanism to create consistent credit decisions and to appeal those credit decisions. So in my first bullet point here, consistent and formulated policy is the manager's best friend. I just said that. You never want to be considered the manager that's making arbitrary credit decisions, fair and consistent across the customer board. Second, I guess I made it. Here's a typo. I repeated 1 2 times. I just missed that. So I'm going to go on to third. I hope I didn't miss it. Clear delegation of authorities. Titles don't dictate credit decisions. The DOA does. So often somebody in an organization, because they are vice president of blank, thinks they can come in and tell credit manager that you have to do what I tell you because I out-title you. But that's not the case. It's the delegation of authority that sets that, not titles. And finally, when conflicts persist after reasonable discussion, then escalate the credit decision. And my theme here is don't fight, escalate. So going back to the CRF paper, in this paper, this is divided into these 6 sections. And each one of these sections asks a lot of questions. And in there is a subset of these questions. So what I would envision, if you were trying to develop a credit policy, you would be in a room, maybe having a Kazan event for a credit policy. You'd have your yellow stickies, and you might say, well, what is our mission? And people would write things on a yellow sticky, and you might stick them up on the board. What are our goals? And what are the specific credit responsibilities? That's a very important one. In some organizations, credit people don't collect. Customer service people collect. How is credit evaluated? How is collections handled? And what of our terms are sales? All great questions. The paper's full of questions. And like I said, I envision a team of people in a room with yellow stickies coming up with answers, and then you would probably group those into major categories. And I think you would come up with a credit policy with probably 5 components. And these would be the 5 components: an introduction, a delegation of authority, credit terms, credit limit management, and accounts receivable management. This is all fairly basic. Most credit policies have that. So what we'll do is we'll go back, and now we'll just talk about what you might have in these 5 sections. Again, in the introduction, I think it's very key to establish your mandate for a credit policy, which we discussed in slide 11. And that is very important, that this is mandated by the board of directors, handed down to the CFO, and entrusted to the credit department. They need to know that when these credit decisions are not you acting arbitrarily, this is a directive from the board of directors. Create a purpose or mission statement. Again, going back to those questions and those yellow stickies, and create your company mission statement for credit. Now, then to the nuts and bolts. What I like, this comes from my experience, I think that you should have a definition or a recital section in your credit policy. And what I mean by that, you want to define key terms. For instance, if you have a title in your company and you use that in the credit policy, you have to spell out what that title means. Or even, ironically, CFO. Sometimes people don't know what CFO means. It's the Chief Credit Officer. And then you need to develop, sometimes in credit policy, we get very loose with the words should, must, and may. You need to define what should means, what must means, and what may means. Sometimes should and may are the same thing. And here's an example. Credit under $100,000 may require financial statements, while credit approvals over that amount must have financial statements. And then finally with our credit policy, and this is not just the introduction, it's the whole credit policy, don't make your credit policy stricter than you intend to enforce. And I had that just at this company when I was reviewing the credit policy for our European division. I read it and I called the director of finance and I said, you realize when a customer goes past due, you're not allowed to release an order. And his answer was, yes, I realize. I made it intentionally that tough so that people would understand how strict we are. And then I could release the orders. And I said, but then when you release the orders, you're in violation of your policy. And then I'll give you another example. I redid the credit policy here. I implemented risk ratings here. And I said that all accounts, all customers within Novus should have a risk rating. I didn't set a time frame for this new initiative and forgot to incorporate into the credit policy that this is a huge undertaking. So I immediately, when the auditors came in, I had an exception to policy that I wasn't enforcing, and it was my own fault. Additionally, don't put procedures into policy. If you're on an SAP system, you want to avoid, if you collect, go to the XT screen and do this and do that. You can write a procedure for that. That just bogs down your credit policy and people get lost in it. Avoid using proper names, company names, form names. Example, and I've seen this a lot, where the policy says pull a D&B report. Well, that's great, but what if you switch D&B services or you're going with credit to B? Just say credit agency report. Avoid using form 178. Well, what happens if you revise the form? Then you have to put 178A, and before you know it, your credit policy is out of date, and auditors are giving you exceptions. Finally, and if there's a hypothesis for these first 5 sections of credit policy, that the delegation of authority, it can be a section in your policy or it can be an appendix just outlining what your delegation of authority is. My hypothesis is this is the most important part of credit policy. If you do not have a credit policy and your life is tough, first get a delegation of authority with credit authority and get it published in your company. If you can't do anything else under time, this would be the most important thing. It is the center of what's going to drive your credit management, your terms, your credit approvals, your collection actions, and your order releases. So the credit limit approval processes, this is what I would call for new credit or more credit. And you want to distinguish between what is a must-have and what is a nice-to-have. And I think that is important to what we had discussed before. Don't get yourself in a trap. And your wish list on your nice-to-haves obviously can be relative to the size of the credit limit amount. I mean, obviously, full audited financial statements that are unqualified by a large accounting firm are really great. But we don't need those for a $1,000 credit line. Define when guarantees or credit enhancements are required, so that when you go back and say, I would like a personal guarantee, I would like X, I would like a letter of credit, I would like this, that is defined in policy when the credit department would ask you for such a credit enhancement. And here's some helpful hint on the credit application. I'm just going to discuss two that have saved me in the past, the last two. The governing law should be the law of the state that you reside in, which most applications and invoices will state. But what they fail to state is the venue of where you want to have your court proceedings. You want that in the courthouse next to where your office is, not where the customer is. When that happens, the customer has you over a barrel, and they play games with continuances. And I have sent many people out to testify only to have the court date by the debtor intentionally continued, just to make it a pain for us. Another section would be payment terms, and here again it depends how your company views credit terms. And what I mean by that, does your company have standard terms? Most people say our standard terms are 30 days. Or they might publish a chart of what our standard credit terms, depending on what the country is, what the market is, what the product group is. Sometimes your company has multiple products, and this product is customarily 30 days, and this division is customarily 60, and we have that. That's fine. I'm not telling you that what your terms of sales should be. What I'm saying is that you should publish those terms of sales in your credit policy, or periodically publish them and have your policy dictate that the credit department, and then to point number two, other functions that you deem should be involved in that, publish that as well. So you might work with sales, you might work with a product group to come up with what your standard terms are. For countries, you might work with your Treasury Department, depending on what risk you know those countries for standard terms. Now, many companies don't have standard terms or cash sales, and what they say is, we will extend you credit, but only after a credit investigation. And this is obviously the most conservative approach, but not always the most practical approach. However, there are certain companies that practice this, and I would say trading companies, grain traders, who have very low margins in their transactions. And I'll give you an example. I sell to a customer in Peru. They have open credit with a large credit line. One of my sister companies, which is a grain company, they have no credit terms because there's a 1% margin in this grain trade. Additionally, they may even require a letter of credit because the profit is so thin in the transaction that if something happened and the transaction was canceled, they can't even profitably load the grain back on the ship or turn the shipment around and send it to another market. So, and I'm going to add this too. This is my recommendation if you're selling internationally where you don't have local offices, meaning export, customer picks it up at port, no local office. I think you should start in those situations, this is my opinion, with no credit or letters of credit, and the customer has to give you the information to make you comfortable with credit. So, and the final consideration, do you consider account profitability when granting terms? And obviously, lower profitability necessitates granting lower credit terms. Just the time value of money alone would dictate that. And I'm not saying that all credit policies have that. It would be the nicest thing to have, that you had a profitability section in your credit policy. But on the other hand, it should be part of your credit decision. So credit limit management, this is after a credit limit is issued. What mechanisms do you have when customers come close to their credit limit? Now, many companies, they have mechanisms for allowing temporary over credit lines. And the questions you need to ask, how much are you going to let a customer go over your limit? You can program that into your ERPs. Then before that's kicked out, how long can a customer be over their credit limit? What I would say here is, if you're over your credit limit for X amount of months, that's really a permanent, and you should seek out a permanent credit approval. And then you should have an action plan to bring the customer compliant. Again, this should be addressed in your credit policy. And finally, your delegation of authority is required for all temporary overline of credits. Now, some of you are probably on the line saying, what is this guy talking about? We never go over the credit limit. And that's fine. There are many companies that don't allow this, and I understand. Again, for the reasons I said, there's very little profitability. You're a trading company, so you don't want your customer to go over the credit limit because you have a liability on the supply side. I get that. That was, just my opinion and my background. Then in your credit limit management, you need to have reasons for when you suspend your credit limit. And I'm going to give examples, obviously not all inclusive. Inactivity is a huge risk. Those accounts are inactive for X amount of time. A customer gets in some financial difficulty. They've been cut off by their supplier, and this has happened to me. They go and they say, who else do we have accounts with? And they order from you. Obviously, excess past dues, bounce checks. Again, you set the parameters. If the account goes past due 2 times within a 6-month period, credit will be suspended, or credit must be reviewed. Bounce checks, credit is suspended. And obviously, deterioration in financial condition, which you can get through credit reports or financials, and you can suspend credit on deterioration in financial conditions. There is UCC law to protect you in doing that, and also generally your invoices should have a term that allows you to do that. Then accounts receivable management is, I'm going to move it along here real quick because we're under some time constraints. Obviously, you just want to have your matrix on how you manage your past due. And one thing you want to do is don't conflate credit limit management with accounts receivable management. If your customer is over credit limit because they're past due, you follow the accounts receivable management matrix. You don't follow the over limit matrix. And you have predefined collection activities so your customers and your salespeople know you're treating them fairly. And what I would say in those last 2 bullet points there is that sometimes our payment plans in these days of email is email communication, and that's fine. It's a nice documentation over the old days where maybe it was phones, records only, and notes in the system. However, at some point, if this plan goes over a certain amount of time, your credit policy should say it needs to be a structured plan, meaning the customer should sign it. And there's a whole other reasoning for doing structured payment plans, which we won't get into today, over just an email plan. And again, disputes over how collection activity is handled, again, follow the DOA, but I would limit that DOA. I think when customers are past due and having trouble, you want to have an escalation, but you want to be very limited. Maybe yourself and the CFO, and that's about it. So I've given you the basics of a credit policy, and as one of my favorite characters in the movie Eraser, which I was discussing with Justin beforehand, the movie was well before his time, Tony Two Toes says to Arnold Schwarzenegger, so Mr. 60 Minutes, tell me something I don't know. So I'm going to talk about advanced components of credit policy. In addition to those standard components, I think that there are 4 more components which really solidify us as a credit department as a valuable separate entity, that 4th point that Cliff Miller was making in the CRF paper. And those components are risk rating, meaning rating your assets, addressing your bad debt reserves and write-off policy, profitability, and reporting. So maybe Mr. Tony Tuto says that I did not know. So on the risk rating, the purpose of the risk rating, and this is separate from credit scoring, is to create an objective standard that we all talk the same language in a credit organization. You would be, if you all know, talking to salespersons, leverage, liquidity, turnovers, eyes gloss over, the hair starts flying back. Even some finance people, they understand very well gross profit. They understand SG&A, but sometimes their balance sheet knowledge is much less than people in credit department. So this does create a language which we can talk to them, and you can say you're treating everybody fairly because this person had a higher risk rating. So I'm going to manage this account more strictly. I'm not going to allow over limits. I'm not going to allow any past due. I'm going to also use this risk rating because they were a risk rating X. My policy requires I need some sort of credit enhancement, letter of credit, bond, credit insurance, guarantees, whatever your credit policy wants you to do or whatever you want to do. Risk rating reserves can be the guide or even the trigger to put that account on some sort of watch list or even a higher level of scrutiny, which is the bad debt reserve report, which you're actually allocating bad debt to. And risk rating can be used in term decisions. If you have a higher risk rating, you can say, well, I can give you the 30 days. But unfortunately, since they were a lower rating, I either need this credit enhancement or I need to cut the terms and the credit limit. It gives you a ground to speak to these people rather than trying to throw out leverage ratios, activity ratios, and some things, and even a D&B rating or a COFAS rating, which they may not understand. And it can be used in the pricing discussions. I worked at a company, we had a profitability model. We ultimately added to that profitability model, our risk rating, which made the relationship have a higher return on invested capital, or WACC rating. And the lower the rating, if that rating required bad debt reserves, which had to be funded, it had to have a higher profitable relationship to help fund the bad debt that the company had to carry that relationship. So in my prior discussion, I talked about DOA being the centerpiece of those first 5 sections of your credit policy. To me, your risk rating is the center or the cornerstone of what you do when you're managing your profitability, your watch list, your stricter credit management. Even many of us have ERPs that we can write rules for our staff and how they collect. We can use the risk rating in those rules. And the bad debt reserves, the write-offs. I didn't put it in this rating in this presentation, but because it's a sub-issue, which is sometimes we want to take our assets off our trade and put them into non-performing or non-current. Risk ratings can be the basis or the justification for doing that. So what is the risk rating models? Again, I think it should be a proprietary model, one that you engage in developing yourself in your organization. Now, you can use elements, the financial information, the credit score reports, credit agency reports, which I mean like Moody's, if that's available. The payment history, obviously an element that could be in here. The customer profile, and what do I mean by that? Well, for instance, a distributor might have a higher risk profile than, let's say, the customer you normally sell to. So in my business, we sell to a lot of chicken producers. But for the smaller producers, we sell to distributors who sell to the smaller guys. The distributors obviously have lower profit, higher leverage, lower liquidity, lower cash flow. So that might be a risk point against them. And in international, you would want to look at political risk, economic risk, FX risk. You can get very clever depending on how good of an Excel person you are or on your staff. I had some that are very good. And we could create these models, and if you didn't have financial information, it weighed more heavily to the credit scores or to the payment history or to the credit profile. If you had financial information, it might say, okay, well, the fact that they're a distributor doesn't count as much against them because they did give you financial information. I know that there are third-party vendors that provide this. Moody Analytics, I believe B2B offers that. Credit to Be offers that, so it's out there. So here is what I'm trying to say. If you have a risk rating, and what I tried to do here is translate various services that offer risk ratings. And this column here where it says typical OCC bank rating, I put that in here. I like this. I use this internally, and how that translated over. Now, the purpose of this is a nice little reference if you ever wanted to see how S&P, Fitch, and Moody line up. But on the other hand, too, it tells you the big circle in red below, if you have assets in those categories, you should be really looking at bad debt allocation based on this. And I think in my company, off the top of my head, a 4 maybe 0 to 20, a 3 maybe 20 to 50, and 2 is a 50 to 100, and 1's a total loss. So that's where the risk rating can be very valuable to you. Maybe a 5, 4, and 3, or I'm looking at the COFAS ratings, so I confuse people. So if you look at the OCC, the 5, 6, and 7s, and 8s and 9s typically could have reserves or limited reserves. Definitely your 4 and 5s might want to be on a watch list. And so what's the purpose of these watch lists? And I think we'll get into that later. But this is an idea. What I'm trying to communicate here is you can use these ratings internally, your proprietary ratings, to tell people why you're asking for reserves, why you're managing more strictly. And here's another hypothesis, a theory of what I'm trying to communicate to me. For credit to play a larger role in the company, I believe it is imperative for credit and the manager to manage the bad debt reserves. And so what does that require? The credit policy should address that you are the keepers of the bad debt reserve and you're the manager of it. Monthly, and this should be in policy, you should perform your bad debt analysis. You want to call out your specific reserves for known risk accounts. You may have general reserve formulas based on market, your agings, or your countries. Or you can even have what's called a concentration risk. And that can happen for, it's just a big customer, and we're required to have a concentration risk based on that. I'll give you an example. I worked for a company, and there's 10 major hospitals in New York City. We sold to all of them. They were all in financial difficulty. We knew one was going to go under. We didn't know which one. So we set what we called a concentration of market risk in that market. Based on the sales of every hospital in New York City, one did go bankrupt. And then finally, I think credit should have broad authority to set bad debt in conjunction with the CFO. This is really to protect the company. Auditors don't like to see the bad debt reserve to manage earnings because you can play tricks with it in very high profitable years. You know, there might be a temptation. We'll take the bad debt hit. We earned a lot of money this year. And then when the profit's not so good, we'll say, well, you know, maybe our portfolio is not so risky. Why don't we release some of these bad debt reserves into to earnings? And auditors do watch for that. They want to make sure, that's why they like the credit manager to have a lot of authority and a lot of autonomy in setting the bad debt reserves. Finally, this is for the watch list, the BDR, and write-off. Credit managers, and I get this all the time, don't feel you failed by putting a customer on a watch list. Rather, neglecting to timely place the customer on the list is the failure. Ideally, we want to have a situation where first the customer appears on the watch list, and if we can't correct it with all our action plans, then they go in the bad debt reserve. We allocate some reserves to them. We still try to work through the issues, and finally, then we write off the customer. That's how we ideally want that to work. The rule of thumb is no surprises, and I have O surprises because I typed that just before the presentation. I forgot to put the no in. I'll correct that. But here is my personal experience. Every time I walk into the CFO's office and say, we had a bankruptcy today, or I believe we're going to take a loss in this customer, we've turned it over to an attorney. Doesn't get into the weeds on me, what happened, what was the ratios, blah, blah, blah. The first question is, are we reserved? If the answer is yes, it's a very short conversation. Generally, I walk out of the office. If we're not reserved, it's a very long conversation. So out of profitability, this is where I'm going to go with this. You may not be able to put a profitability section into your credit policy. Obviously, I think that would be the best way to go. But at a minimum, credit should work cross-functionally with finance or sales reporting, which calls out low and unprofitable relationships. So if sales organizations generally put out our low profitability customers, get a hold of that list and say, and by the way, they're our highest credit risk. It draws a lot of attention to those customers. Sales, because it's a credit risk and it's a low profitability, they're the ones then that might want to get out of that relationship. And then I would also say that in your credit decisions, profitability should be considered in the credit terms. And the reason why I say that is sometimes you might say no because it has more risk. And that's the right decision. But sometimes we can look at it and say, you know what? it is more risky. It might be a 4, and normally we like to see 3s, but this one has a gross profit of 40%, and most of our relationships have 30%. That should be a consideration into taking that incremental risk. In a perfect world, I say credit would be involved in the floor pricing or the pricing committee meetings, and I'm going to tell you that doesn't always happen. So where I want to go, how should your credit policy address that? That above normal credit, above normal profit can mitigate the risk. And I'm going to summarize this here because I want to move along here pretty quickly, is that if you have higher incremental profit, you can use that to fund your bad debt reserve. In essence, you're creating your own insurance policy within a company. Also, I want to emphasize that we talked about this earlier. Are you taking the bad debt hit? Or do you, in your credit policies, say the division that takes the risk takes the P&L hit? My opinion, bad debt should not be charged to finance, accounting, or worse, to your credit center. It should be charged to the sales division that's taking the risk and incurred the bad debt. And I would also encourage your business units that take the risk that you help them forecast the risk in their monthly or their annual budgets so that they're willing to put their money where their mouth is, saying, I want to take a little bit of extra risks and I'm going to budget for it. And by the way, that was approved by management. Finally, I'm going to go over this one little point here, and I'm going to move very quickly. I think that you should put reporting. Many managers don't report AR results. They come out somewhere else, but that should be in your policy. Some of the things we talked about today, the bad debt, the DSO, that kind of stuff. I also think you should create dashboards with KPIs. And then what I want to also talk about is that you should put a written analysis out, and don't be afraid to put commentary why your results were as such. If there is one customer that's causing the problem, call that out and say what we need to do to improve our results. So to improve our DSO, we need to lower our standard terms of credit to this set of customers that are taking advantage of the company. I think you should put commentary into that. The final thought, so when you come in and tell your boss that a customer suddenly filed bankruptcy, was it unexpectedly? And I think if your policy and your management style said you knew about the risk, you can document efforts that you mitigated that risk, management was aware of that risk. I'm going to pick up the headset, my handset, the headset was almost dying. Management was informed of the risk via risk ratings, bad debt reports, watch list. Did you allocate specific reserves to lessen the sudden impact of the bad debt? And did you have enough incremental profit in that relationship to fund that or partially fund that bad debt? If all the above is true, then credit is a valuable contributor and resource for upper management. And that's the end of the presentation.
All right, thank you very much, Gerald, for taking the time to present. I do have a couple questions in here, and I just want to let everyone know if they do have any questions, they can feel free to use the questions function in their side panel. Before we do begin those questions, I do just want to remind everyone that we will have a brief survey that pops up as you exit the webinar. It only takes a few seconds to fill out, but we get a lot of great information from your responses. One of the questions we're getting again is if everyone will be able to get a copy of the presentation. We will be giving a copy of the presentation to everyone who attended today's webinar, so you'll get that either later today or first thing tomorrow.
And I'll try to fix those couple of typos I found before it goes out.
Yep, perfect. All right. So the first question we have here is, how should a credit policy be created if a company is obligated to comply with SOX requirements?
Well, I think my experience is that SOX requirements is going to follow what you have in your policy to a large degree. There's not, so when SOX is developed, there's a symbiotic relationship with your credit policy. So for instance, in your credit policy, and I think this is where the question's going, it's a good question, is that you say, I'm going to review all accounts over X credit limit every 12 months. Well, then there's going to be a SOX control that says, how did you execute that? And then the auditors will do testing to see if you did that. And by the way, you normally have to develop the test for the auditor to tell them that you did what you were doing. So don't think SOX is your credit policy, but when you have your credit policy, SOX will lean very heavily to make sure you're executing. That's why in one of the very first points of the presentation, I said, at the very beginning, I hate to go all this, is don't trap yourself with the credit policy. And what I'm saying, that's where SOX comes to bite you, that you made something so strict you had no way of ever executing on that, and that's where SOX will bite you.
All right, the next question we have here is there more information or details you know of to be available regarding customer credit ratings?
Okay, so obviously, and I go back to the presentation, and what I said is that your credit rating should be proprietary. So information you can come up with that obviously is the financial information. And then you can use credit scores of other agencies, and that can be an element such as D&B, COFAS, Credit to Be, Moody's reports, intelligent reports, RMA data, if you have the ability to get to that. You know, unfortunately, I think in the prior presentation I did have a list of those intelligence. If that person would want to email me, I can send them a list of, there's just tons of it out there. And okay. Now, modeling, software that actually helps you model, again, your own internal spreadsheet, I think, and I'm not on the platform, the DNBI platform allows you to use that. Their information and other information. I think the Moody's Analytics, which many of us probably get emails from, has a module that lets you develop your own risk rating model. It is expensive. Some of the attendees I know are SAP and they're on FSCM, and that has modeling built into it. So there's a lot of information on that.
All right, the next question we have here is, can you further clarify your statement regarding which state to hold court in, and could this be listed on the invoice terms or on the standard credit application?
Okay, so I'll clarify that comment. So many times our invoice and our application will say the jurisdiction is the state of Missouri. That's where I live, so I'll use that as an example. But it does not define well where the court shall be held. And what can happen is the debtor can successfully petition the state court he lives in or she lives in, and you have to travel there, which creates so much headaches that we then, depending on the size of the debt, drop the case. So you want to put in your invoice or your application that the venue is also the state of Missouri, or the state that you're located in, or the county of St. Charles in the state of Missouri. So now to the question specifically, you have an invoice with terms and conditions, and you have an application with terms and conditions, technically. There's many approaches you can take. You can make the application silent on that point and put it into your invoice, and that way there's no conflict between the two. Or you can have it on both, the invoice and the application. But then you have to always make sure your invoice is consistent with your application. I would highly advise against having it in your application, but not in your invoice. So I would tend to make sure it's in your invoice. That's where I would make sure that you put that language in.
All right, the next question we have is, for international credit, do you think there are better credit agencies in Latin America versus Asia versus Europe?
Okay, so Asia, it is hard getting, depending on where you go, because of, especially China, some of the agencies left China because they didn't want to be accused of spying or espionage or whatever was happening to them. But we have found that Expensive at D&B had some good reports. COFAS and what I would call the APEC region has good reports. In Latin America, I found that COFAS has good reports, good ratings. In Brazil, you want to use a company called Serasa. And that is, I think they're affiliated with one of the big ones, Experian or Equifax. I forget which one.
It's Experian.
It's Experian. What makes Serasa so good is in Brazil, you have a process called protested checks, which means the customer, or protested invoices, excuse me, miss their invoices. And when you report those nationally, it's a very serious offense. So it's not something you do willy-nilly in Brazil. That instantly gets picked up by Serasa, and they'll inform you. So Brazil, that's just a must. I have some other references for Latin America, one I used to use a lot, but I don't want to put the name out in this venue. If someone wants to talk to me privately, I'll go over the pluses and minuses of my experience with that company for Argentina.
All right, it looks like that's all of the questions that we have for today. I'd like to thank everyone for taking their time out to listen to Gerald present, and I'd also like to thank Gerald for taking his time out of the day to present to our audience. So on behalf of Credit to Be, the Federation of Credit, and Gerald, I'd like to thank you all again and hope everyone has a great rest of their day.